What actually changes when your net worth starts going up? Not your habits, not your thinking, not even your financial stress. At least, not in the way you expect. In fact, for most people in the United States and Europe, more money doesn't remove financial pressure, it just upgrades it. Scene 1. Early career reality. You're 24. You land your first real job. Maybe you're earning $3,500 a month after tax. It feels like progress. But then the structure of your life starts forming. Rent, $1,200. Car payment, $400. Insurance, groceries, utilities, another $800. And just like that, you're left with maybe $1,000. That's before student loan payments, before going out on weekends, before anything unexpected. So what happens? You don't feel broke, but you don't feel stable either. So you use a credit card just to smooth things out. Not recklessly, just temporarily. But that temporary gap, it quietly becomes permanent. Scene 2. The first financial trap. Here's the part no one really explains. Debt doesn't feel dangerous when your income is rising. It feels manageable. Let's say you carry a $5,000 balance on a credit card at around 20% interest. That's roughly $1,000 a year just to stay in the same place. No progress, no ownership, just maintenance. But psychologically, it doesn't register as loss because your salary is increasing. Your lifestyle is improving. So your brain says, I can handle this. And that's the first trap. Not overspending, but normalizing the cost of borrowing. Scene 3. Mid-level income shift. Now you're 30. Your income has grown. Maybe you're making $6,000 a month after tax. From the outside, everything looks better. Better apartment, maybe you upgrade to a newer car, you travel a bit more. But something subtle happens here. Your fixed costs grow faster than your awareness. Rent becomes $2,000. Car payment increases to $600. Subscriptions, insurance, lifestyle creep, another $1,500. Now you're spending around $4,100 to maintain your life, and you still have debt. Maybe student loans, maybe lingering credit cards. Maybe a personal loan you took to reset. So even with more income, your margin doesn't expand much. It just shifts upward. Scene 4. The second financial trap. This is where people make a more expensive mistake. They start optimizing monthly payments instead of total cost. For example, instead of asking, should I buy a $30,000 car? The question becomes, can I afford $550 a month? And the answer is usually yes. But here's the math behind that decision. A $30,000 car financed over 6 years at 7% interest ends up costing you closer to $36,000. That's $6,000 lost, not because of the car, but because of time and interest. And again, it doesn't feel painful because it's spread out. Scene 5. Psychology behind it. Why does this keep happening? Because humans don't experience money in totals. We experience it in moments. Monthly payments, small upgrades, manageable increases. And there's also social pressure. At this stage, your peers are upgrading too. Better homes, better cars, better experiences. So staying financially responsible starts to feel like falling behind. Not logically, but emotionally. Scene 6. Higher income, higher complexity. Now you're 38. Maybe your household income is $10,000 a month after tax. You've made it by most standards. But your financial life is now more complex. Mortgage, $3,000, 2 cars, $1,200 combined, childcare or schooling, $1,500, everything else, $2,500 plus. Now your monthly obligations are around $8,000 or more. And here's the uncomfortable part. You're more dependent on your income than ever before because your lifestyle requires it. Scene 7. The third financial trap. At higher income levels, the trap isn't obvious debt, it's structural dependency. You don't feel like you're borrowing, but your entire life is built on continuous earning. If your income stops, even temporarily, the system collapses quickly. And that's when people realize they don't own their lifestyle owns them. Scene 8. Long-term impact. Let's step back and look at the long-term effect. If you consistently carry debt, upgrade lifestyle with income, and prioritize monthly affordability over total cost, you might earn well for 20 to 30 years and still end up with limited real wealth. Not because you didn't make enough, but because too much of your income was committed before you ever had a chance to keep it. Scene 9. Perspective shift. Financially intelligent people don't look that different on the surface. They still earn, they still spend, they still live normal lives. But their thinking is slightly different. They don't ask, can I afford this monthly? They ask, what is this costing me over time? And what is it replacing? Because every financial decision replaces something. Future savings, flexibility, time. And once you start seeing money that way, the game changes quietly. So as your net worth grows, the risks don't disappear. They evolve from visible debt to invisible commitments, from survival pressure to structural pressure. And most people never notice the shift until they're deep inside it, not because they were careless, but because the system is designed to feel comfortable while it compounds.